Imagine a life where your investment works for you. Maybe a stunning villa in Phuket, Thailand, overlooking those amazing turquoise waters, generating, beautiful, consistent rental income. It's a dream many of us share, right? A tangible piece of paradise. Okay, let's unpack this dream a bit. It's not just attainable, it's financially smart well if you approach it with the right knowledge. Our deep dive today is all about making sure that vision of passive income isn't just, well, picturesque, but also profitable and fully compliant. We're going to navigate the ins and outs of rental income tax in Thailand using a really comprehensive guide that's designed for investors.
Oh,
Our mission basically is to arm you with the critical knowledge to understand Thai tax laws so your investment thrives without any unwelcome surprises from the tax man.
yeah. And what's truly fascinating here, I find, and often a bit of a pitfall, is how tax considerations sometimes get pushed to the back. They tend to be an afterthought for investors, especially when they're captivated by the allure of a place like Phuket. But getting your head around the fiscal landscape isn't just about ticking boxes. It's actually foundational for long-term profitability. It really means the difference between a good investment and one that genuinely maximizes your returns. We're basically going to give you a shortcut here to being well-informed, and hopefully there'll be some real aha moments about deductions and even tax refunds you might never have expected.
Absolutely. So let's get straight to the fundamental principle here. If you're earning rental income in Thailand, the Thai government expects its share. It's pretty straightforward, really. Regardless of your citizenship or, where your bank account is, if your property is located in Thailand, that income falls under Thai tax laws. Our sources really highlight that Section 45 of the Thai Revenue Code explicitly lists income from leasing property as taxable. That covers everything from those luxurious villas to modern condos and even commercial spaces. But I imagine one of the first questions an international investor would have is, does it matter if I actually live there, or am I still on the hook for tax?
That's precisely where we make a crucial distinction. Thai tax residents versus non-residents. For tax purposes, you're generally considered a non-resident if you spend less than 180 days in Thailand within a calendar year.
Okay, less than 180 days.
Right. But this doesn't exempt you from tax on your Thai-sourced rental income. Non-residents are specifically taxed on income generated within Thailand. So your rental earnings from Phuket are definitely on the Revenue Department's radar.
Right.
So this raises an important question.
Okay.
What are the immediate sort of practical steps you need to take as a non-resident investor? Our source gives us a quick rundown. First, you'll need to get a Thai Tax Identification Number, or TIN, from the Thai Revenue Department if you don't have one already.
A TIN. Okay.
Think of it as your official tax identity for Thailand. Second, and this is really crucial, you must maintain meticulous records of all your rental income and every single expense.
Every expense.
Every relevant expense, yeah. And third, you are obliged to file an annual personal income tax return. The core insight here, I think, is that good organization from day one isn't just about neatness, it's a direct financial lever. If you don't have proof of your legitimate expenses, you could end up paying significantly more tax than you actually need to.
Okay, so once we understand who needs to pay, the next logical step is how much. And this is where it gets really interesting. Figuring out the actual tax rates, because they vary quite a bit based on your residency status. For Thai tax residents, your rental income gets lumped in with any other earnings you have throughout the year. Thailand operates on a progressive tax system, right? Meaning the more you earn, the higher the percentage of tax you pay. Can you walk us through those progressive brackets a bit?
Certainly. The rates mentioned in our sources are actually quite favorable for moderate earners. For instance, income up to $150,000, Thai baht is taxed at 0%.
0%, wow.
Yeah. Then a move to 5% for income between 150,000 won and 300,000 baht, and it escalates to higher percentages for, very large incomes. This progressive system applies to your net income, that's after all allowable deductions. It's designed to be equitable, really, making sure those with higher earning capacity contribute more proportionally.
Okay, that makes sense for residents. What about non-residents?
Now, for non-residents, the situation's a bit different and maybe simpler in some ways. You're generally taxed at a flat rate of 15% on your gross rental income.
Gross income, not net.
Exactly, gross. The key insight here is that you don't benefit from those lower progressive tax brackets that residents do. So, for example, if your annual gross rental income is 500,000 baht, you'll pay 15% of that amount, which is 75,000 baht, straight up. This rate applies regardless of any other income you might have outside of Thailand.
And what about investors who choose to hold their property through a company? I know that's a pretty common strategy for various reasons.
That's an excellent question. For investors using a limited company registered in Thailand, that income falls under corporate income tax, or CIT. The standard rate there is 20% on net profits.
Net profits this time.
Right, net profits. And while this strategy offers distinct advantages, like, separating personal and business liabilities, it also introduces more complexity. For instance, profits distributed as dividends to shareholders might be subject to further withholding tax, depending on specific tax treaties and your residency status. So while it offers liability protection, it often means more admin overhead and a more complex tax structure overall, something to weigh up carefully.
Right. So you've secured that beautiful villa in Phuket. It's generating rental income. Now, the million-baht question for any investor, how do we actually reduce that taxable income? I imagine Thailand's tax system isn't just about collecting. There must be smart ways to minimize your burden.
Absolutely. And this is where savvy investors can really make a difference to their bottom line. Thailand's tax system offers two main options for deductions. First, there's the standard deduction. This is often set at 30% of your total gross rental income.
30%. Okay.
Think of this as a kind of no questions asked allowance for general expenses. It definitely simplifies things, especially if you'd rather not track every tiny cost meticulously. It's straightforward, often convenient.
And the second option.
The second, and often more powerful option, is claiming actual expenses. This is for situations where your documented costs add up to more than that 30% standard deduction. And this is precisely why that earlier advice about keeping meticulous records is so crucial.
Right. The paperwork again.
Exactly. We're talking about significant costs here. Major repairs and maintenance, property management fees, insurance premiums, even the costs of advertising your rental property. But, and I really can't stress this enough, you absolutely must have proper documentation, clear invoices, receipts, bank statements. The Thai Revenue Department will want to see proof if they ever audit you.
Makes sense.
So if we connect this to the bigger picture,
Yeah.
a higher deduction directly translates to a lower taxable income, and consequently, less tax leaving your pocket. Let's use an example from our sources to really drive this home. Say you have a gross rental income of 1,000 baht for the year.
Okay.
The standard deduction would automatically be 300,000 baht. That's 30%. But what if your actual properly documented expenses, repairs, fees, etc., came to 400,000 baht?
Ah, more than the 30%.
Precisely. By choosing to claim those actual expenses, your taxable income would be 600,000 baht, not 700,000 baht if you'd just taken the standard deduction.
Wow, that's 100,000 baht difference in taxable income.
Exactly, just by being diligent with your paperwork. The core insight here is that proactive record keeping isn't just compliance, it's a direct profit multiplier for your investment. Don't leave money on the table.
That's a truly significant potential saving through smart deductions. But hang on, before that income even hits your bank account, there's another crucial layer of tax to understand: withholding tax. Can you explain what that is and why it's so important, especially for foreign property owners?
Of course. When you're earning rental income in Thailand as a non-resident, there's this mechanism called withholding tax. The standard rate is 15% of the gross rent.
15% withheld upfront.
Yes, but here's the critical point. It's not necessarily the final tax you owe. Think of it more as an advance payment. Your tenant, or much more commonly your property management company, is legally obligated to deduct this 15% from your gross rent before they pay you the remainder. And they send that 15% directly to the Thai Revenue Department.
Okay, so it's taken out before I even see it.
Usually, yes. And this is where it gets really interesting for property owners, because that 15% that was withheld acts as a credit against your overall annual tax liability when you file your personal income tax return. What's fascinating here, and honestly often overlooked, is the potential for refunds.
Refunds? How does that work?
Well, if the total tax you actually owe for the year, after applying all those deductions we just discussed, turns out to be less than the total amount already withheld via that 15%, you can claim the difference back from the Revenue Department.
Ah, I see.
This is precisely why diligently keeping all your withholding tax certificates is so incredibly important. They are your proof of those prepayments. To illustrate the impact, let's look at some scenarios from our sources. With a maybe lower rental income of, say, 500,000 baht gross, 75,000 baht might be withheld throughout the year. That's 15%. But your estimated tax payable after claiming deductions could be as low as 30,000 baht.
So you'd get back.
A potential refund of 45,000 baht.
Wow.
And for a moderate rental income, maybe 1,000 baht gross, 150,000 baht might be withheld. If your calculated tax payable is, say, 80,000 baht, You could be looking at a 70,000 baht refund.
That's substantial.
It really can be. The key insight here is, don't just mistake withholding tax for your final tax bill. It's a powerful prepayment mechanism. If you manage it actively by filing your annual return, it can lead to significant refunds. It's easy to think, oh, tax has already been taken, I'm all done, but you might be leaving quite a bit of money on the table if you don't file.
That potential for refunds really is a game changer for many, I'm sure. It just underscores the importance of not just, understanding these rules, but actively engaging with them. So, okay, we've got our income sorted. We know about deductions. We know about withholding tax. What about the actual process of telling the taxman about it? It's not exactly optional, right?
Precisely. Not optional at all. Beyond understanding the numbers, there are practical steps for fulfilling your tax obligations.
Yeah.
The very first step, if you don't already have one as a non-resident earning income, is registering for your Thai tax identification number, or TIN.
It's TIN, right?
Yeah.
Tax passport. Exactly, your personal tax passport for Thailand. It's typically a pretty straightforward process at a local revenue department office. You'll usually need your passport and some proof of your rental activity, like a lease agreement.
Okay, got the TIN. Then what?
Once you have your TIN, the annual ritual of filing your personal income tax return begins. You'll use specific Thai personal income tax forms. Usually it's PND 90 or PND 91, depending on income types or residency. The deadline is generally around March 31st each year for the income earned in the previous calendar year.
March 31st. Good date to remember.
Definitely. And missing this deadline, unfortunately, can lead to penalties and interest charges, which, no savvy investor wants eating into their profits. In your return, you'll declare your gross rental income, apply those allowable deductions, either the standard 30% or your carefully documented actual expenses, and then, crucially, subtract any withholding tax credit you've accumulated throughout the year.
So you claim back that 15% withheld.
You claim it as a credit, yes. If the tax calculated is less than the credit, you get a refund. If it's more, you pay the difference. It's easy to get sort of bogged down in the details, but the core idea is simple. Report what you earned, subtract what you legitimately spent to earn it, and then settle up based on the remainder, taking into account what was already withheld. Seriously, I've seen people scrambling for receipts at the last minute. Keeping a dedicated digital folder, or even just a simple physical one, for all your property-related paperwork from day one makes this whole process so much less of a headache. Gather those lease agreements, bank statements, repair bills, management fee invoices. Get them all organized as they happen.
Sound advice. Now, so far, we've largely focused on Thailand's perspective. But for many international investors, there's another really crucial layer: double taxation agreements, or DTAs. Can you explain why it's such a good idea to check if Thailand has a tax treaty with your home country?
Absolutely. These international agreements are a huge benefit. They're specifically designed to stop you from being taxed twice on the same income, once in Thailand where you earn it, and again in your home country.
Double tax sounds awful.
It is. And DTAs are there to prevent it. They aim to clarify which country has the primary right to tax certain types of income, and importantly, how relief will be provided in the other country. For rental income from property, the general rule in most DTAs is that the income is primarily taxed in the country where the property is actually located. So, Thailand, in this instance.
Okay, Thailand gets first dibs.
Pretty much.
Yeah.
But the DTA then offers mechanisms for relief in your home country. This might involve your home country allowing you to claim a tax credit for the tax you've already paid in Thailand against your local tax liability on that same income. Or, in some specific cases, depending on the treaty, the income might even be exempt from tax in your home country altogether.
So exemption would be nice.
It would, but it depends entirely on the specific treaty. Some DTAs can also lead to reduced withholding tax rates on certain types of payments, although the 15% on rent for non-residents is pretty standard. This raises an important question, though. How complex can it really get? The specifics of each DTA vary significantly. They aren't all the same. It's not a one-size-fits-all solution.
Right.
That's why it's absolutely critical to keep excellent records of all taxes paid in Thailand, those withholding certificates, any tax receipts, because you'll need these as proof to claim any relief back home. For these cross-border tax implications, our strong advice is always to seek professional tax advice, ideally from someone who understands both Thai tax law and your home country's tax laws.
Makes sense. You need someone who sees both sides.
Exactly. It's far better to sort this out properly from the start than to find out later you've missed out on significant savings, or even worse, made a costly mistake.
Yeah.
It protects your investment from two angles, really.
Okay, let's zoom out for a moment and look at the broader considerations for investors in Phuket. You've got your eye on that piece of paradise, but let's, get real about the money side of things beyond just the immediate rental income tax. I imagine factors like, say, tourism numbers directly impact your potential income and thus your tax liability.
Oh, they absolutely do. Phuket's economy, as we all know, is heavily reliant on tourism. The number of visitors directly affects your potential rental income and therefore your tax liability. More visitors generally mean higher occupancy rates. Maybe you can charge higher nightly rates,
Hmm.
which of course means you'll likely earn more income and consequently pay more income tax.
And the flip side.
Conversely, a dip in tourism, like we've seen happen globally sometimes, means less rental income and therefore a lower tax bill. It's a very direct, almost real-time link between the market conditions and your tax burden. And crucially, it all comes back to ensuring profitability through tax compliance. Look, nobody enjoys paying taxes, but ignoring your obligations is just a fast track to financial trouble. Being proactively on top of your tax duties helps you avoid penalties, interest charges, maybe even legal issues down the line that would otherwise severely eat into your profits. It keeps your investment healthy, legitimate, and frankly, allows you to genuinely enjoy the returns from your piece of paradise without that worry hanging over you. The core insight here, I think, is that tax compliance isn't a passive chore. It's actually an active strategy to protect and enhance your investment's long-term value.
That makes perfect sense. It's part of managing the investment wisely. Now, beyond the direct income tax, I know different ownership structures can have vastly different tax implications too. What should investors consider there?
This is a major decision point, absolutely. The choice of ownership structure significantly impacts your tax situation, your liability, and your long-term asset management. If you own the property simply in your personal name, filing can be simpler, as we discussed. And crucially, there's that clear potential for tax refunds if your actual calculated tax liability is lower than the 15% that was withheld.
Okay, personal name is simpler, potential refunds. What else?
Well, some investors consider using an offshore company. While it might offer some perceived benefits like anonymity or perhaps estate planning advantages in some jurisdictions, it often adds significant layers of complexity and cost. We've seen situations where investors, maybe hoping to simplify things, inadvertently create new hurdles, like potential double taxation issues in their home country, depending on controlled foreign corporation rules and things like that.
Right, unintended consequences.
Exactly. Not to mention the ongoing maintenance fees and regulatory compliance required just to keep that offshore company active. Then there's the option of setting up a Thai company to own the property. This subjects the rental income to Thai corporate tax rates, which we said is typically 20% on net profit. It requires compliance with local Thai company law, appointing directors, annual filings, etc.
But maybe easier to manage locally?
It could simplify local operations, like opening bank accounts, hiring staff maybe, and potentially asset transfers within Thailand. But again, dividends paid out might attract further tax. The choice isn't just about the immediate tax rate. It's really about your long-term asset management strategy, your plans for future sale, maybe how your heirs might inherit the property. Getting professional advice tailored to your specific situation, your goals, and your home country's rules is absolutely key before you commit to an ownership structure. Don't underestimate the long-term ripple effects of this decision.
Definitely sounds like something to get expert advice on early.
For sure. And finally, let's not forget about other property-related taxes that need to be factored into your overall financial planning for a Phuket investment. It's not just income tax.
Ah, yes, good point. What else is there?
Well, there's the annual land and building tax. This is relatively new but important. The rates vary depending on how the property is used, for example. Residential use is taxed at a lower rate, around 0.3% potentially, whereas commercial use is higher, maybe 1.2%. Vacant land can be taxed even higher to encourage development.
So an ongoing annual tax based on the property value and use.
Exactly. Then, if you're buying a new property directly from a developer, there's typically 7% value-added tax, VAT, included in the purchase price.
VAT on new builds,
Yeah.
okay?
And then, thinking ahead to when you eventually decide to sell the property, there are transfer fees, usually split between buyer and seller, typically 2% of the government's appraised value. And there's stamp duty, which is 0.5% of the appraised value or the sale price, whichever is higher. However, here's a crucial detail. If you sell the property within 5 years of acquiring it, a specific business tax, or SBT, of 3.3% usually applies instead of the stamp duty.
Ah, to discourage quick flipping.
That seems to be the intention, yes. So looking at the wider implications, it's really crucial to factor in all these potential costs, the annual taxes, the purchase taxes, the selling taxes, beyond just the initial purchase price. You need this to truly understand the comprehensive financial landscape of your Phuket investment. It's not just about the sticker price, it's the full life cycle cost of ownership.
So there you have it. Wow. We've really journeyed through the intricacies of Thai rental income tax, haven't we? From distinguishing between residents and non-residents, understanding those progressive versus flat tax rates, and discovering the smart savings you can potentially make through strategic deductions, standard versus actual. We've also uncovered the power of withholding tax and those, frankly, quite surprising potential refunds. We explored navigating international double taxation agreements and touched on that whole spectrum of other crucial property taxes. It seems abundantly clear that understanding the tax side of things isn't just a formality. It's absolutely key to making your Phuket investment not just a dream, but a thriving, compliant, and truly profitable reality. And I guess if at any point listening to this it all feels a bit much, don't be afraid to get some help, right? There are plenty of reputable local accountants and tax advisors in Thailand who know the ins and outs. They can ensure you're ticking all the right boxes, saving you time, money, and potential headaches down the line.
Absolutely. And maybe to leave you with a final thought, it's incredibly easy to assume that once that 15% tax is withheld by your tenant or property manager, that's it. It's all sorted, job done. But as we've seen for rental income, particularly for foreign investors, the withholding tax is very often just a prepayment. It's not the final calculation. Filing your annual tax return is your opportunity. It's your chance to reconcile everything, to declare your legitimate expenses, apply the correct rates, and most importantly, potentially get some significant money back into your pocket. It really encourages you, I think, to see proactive tax management not as some kind of burden, but actually as an active profit maximizer for your investment. So maybe a question to mull over is, what stands out to you as the most surprising or maybe the most valuable opportunity for savings in all of this complex picture?